Hello everyone, this is Juan Sarmiento and today is Friday, February the 24th. I have two candidates here, and so before we go into our current trades, let's enter those, and I'm going to make a pause here, just a second. Okay, so I uploaded this spreadsheet you're familiar with more or less if you are a regular watcher, but let's get on with this. I'm using this template to illustrate to you the points that I look at when deciding when to make a trade on a specific stock. Today I'm interested in PANW. That's um, a network stock. Let's go to the charts here and enter that same symbol. It's Palo Alto Network. And why am I interested in? Because in the reported earnings, it has already been going up, and with earnings, it went even higher. The volatility collapsed, and that is interesting to me. Okay, it's a stock that is moving stronger to new highs, but the volatility has declined. Okay, which means it could go up again. Okay, so the first step is to figure out a trade. So let's go to the Analyze tab, and here is my trade. You can easily generate this by simply adding one leg at a time. For example, in this case, I'm going to look for a short that is about 28 days to expiration, a short call. Then I look at the in the money right near the nearest strike price nearest to the current stock price, which is 186. So 185 is what I want. So I'm going to, because I'm selling, I'm going to bid it. Okay, so I'm going to click on the bid here, and that will show it down here in my simulated trades. Just this red negative call. So I'm going to press now the control key and do it again on the bid side, on the put side. Okay, click that only once, and that creates a negative or a short straddle. You can take a look at the chart on it, and this is what it would look like. Okay, that's a short straddle, and the short straddle makes money if the stock just goes sideways. Okay, you can see that we will save money, or we will make money as little as it's going to be if the stock stays on this area. And in the short term, that's very likely to happen. But in the long term, a stock can move very strongly in either direction, and that's what I'm counting on. However, if we enter this type of trade on high volatility, the volatility collapsing would kill me. So I need to make sure that we have low volatility. And the low volatility, I mean, it should be in the lower end of the range, and it should be about below 40 at least. So let's add now the long portion of the trade, and we go now to at least 100, I say 90 days to expiration. You see, that's the date to the expiration of the long-term options. Okay, so we're going to buy long-term options, and we're going to finance it partially with the trades that the options that we're selling. You see how it says credit of 1440? Well, it's going to cost me a whole lot more for the long-term options that I'm buying. So you need to be sure that the volatility is not much different. If you buy high volatility, you're paying too much. Okay, so we are here, and we're going to press the control key again, because now we're going to click on the ask, and it's the same strike price, 85. Okay, so here it is. On the call side, press the control key and click twice, once and twice. And on the put side, press on the ask once and twice. And that is my full trade right now. And you can see what it looks like. Okay, so now the ends are kicked out. So what happens if the volatility collapses? Well, we can simulate that here as volatility. You see that? So I have my trade, and I can just say volatility. and click on this so that you can play with it. Okay, what happens if the volatility goes up 10%? Okay, enter a 0 there, a 1. Oh, it's not accepting it for some reason. We need to put 10 there. I have never experienced this, but it's not accepting it. There you go. You see, as the volatility goes up, my trade begins to become profitable. You can see by the P&L here. Okay, so 3%, 4%, 5%. Even if the stock has not changed in price, just the very fact that volatility increases, I begin to profit. Okay, what if the volatility collapses? Well, then I begin to lose money. Let's say minus 7%. Poof. That's why it's so important that you begin with low volatility, because it either stays the same or goes up. So how do you know a volatility is low or high? Well, we have here this trade and this implied volatility that is in the green. In the green means you can't trade it because now it's below a certain level. It's at the lower end of its yearly rate. Okay, so it's close to 0% here. If it's up here, you're going to lose money for sure. So you don't want to. You want to be in a trade like this before this happens, not after, because then the decline would kill you. Okay, so we want to be entering a trade like this because it's green now. Okay, and you have seen in previous episodes that I have a script to make this chart happen. So if you like that, we can discuss it. Just let me know. Put a note below in the discussion below that you would like to see that explained again. If not, I assume that you know how to generate this chart and it's in the green. Fantastic. Okay, let's go to the trade tab and let's say all products. So you can see then here in the trade tab, you scroll down, it tells you the current IV percentile is 4%. So as long as this is below 15, I consider it a low volatility and I'm good to go. Okay, so let's examine the trade in my spreadsheet. Okay, in my spreadsheet, the first thing is to put the trade here. Okay, I have it, so I copy it from here. Let's copy that, copy trade, take it to my spreadsheet and put it here for future reference in case you need to look at it again. Okay, so how much it's going to cost me? $45.50 times 100. So it's 4,550. Okay, so that means I can put two of those trades at that price. Let's put it here, 45.5. It cost me 9,100, which is about 10% of my account. And that's exactly what I want. As a rule of thumb, 10% of your account. Okay, you can put the expiration and all those details are here for future reference. I'm not going to waste my time on that right now, but you can certainly do that. It's just as a memory of what the trade you're entering is. Okay, let's now proceed to earnings. For that, go to the chart and here you go, and it says 0.118 estimate, and that's the estimate, and the actual was 1.05, so a whole lot more. So in either case, let's put it here. The expected was 0.11. 114, I think it was. Not that that matters much. 11.8. I just want to be precise, okay? Don't have to. And the actual is right there, 1.01. You can ask the broker to teach you how to make this show up in your chart, and they will explain to you what you need to do to make the earnings show up. I have not done recently, so I'm not, I can't, I would have to look it up. So just ask them, how do I make this display of the earnings, and then so that you can hover over it and see the actual and the estimate. And that is, my friends, a huge difference, okay? And it's 7,789%. So you see it shows you this trade. Why? Because the company beat expectation by a wide margin. So that's a trade, that's a plus in my trade. Okay, now we go to volatility skew. Go to the Analyze tab, and here's my trade. You can delete the other one. And you can see that down here in the bottom right corner, I have my volatilities per trade, okay, per leg of my trade. So we start with the calls, the long calls, which are up here, and it says 32.14. 32.14, and the puts 26.01 just turned. Okay, you can see that down here. I'm just merely copying. And the calls short term 28.54. Don't worry if it's changing, it doesn't matter much. It doesn't have to be that precise. Okay, so the difference is 1.75. You can see that the volatility of the options I'm buying is higher, usually is. But as long as the skew is not more than 3%, you're fine. If this number turns out 3% or more, you need to rethink this. Okay, might not be a good trade. Next is the liquidity. How do I figure out the liquidity? Well, you say create duplicate order, and then you have mid and natural. Copy those as well into our spreadsheet here. If you want a copy of the spreadsheet, just drop me a note and I'll be glad to send it to you. Okay, mid is 45.6, natural is 46.5. Okay, and again, it says trade is 1.9 is the difference, and that means the liquidity is acceptable. How do I figure that? Well, because the mid and the natural is liquidity is how quickly it gets filled. If there are not that many trades, let's see, we say if there are not that many traders on this trade, the spread becomes larger and larger. Okay, meaning the difference between mid and natural becomes larger and larger, and then it's harder, it's harder to trade. So if it is really tight, it means it's a lot of people trading this, and it will be very easy to get in and get out. And get out is the most important part. Getting in, you can always adjust your pricing so that it changes, so that it's accepted. Then the current IV percentile, that's easy. Go to the trade tab and scroll down until you see current IV percentile. In this case is 4%. So I go over here, 4%, just enter it here, 4%, and you see that it's a trade. So I'm going to put this in green again, the fill. Just put it in green, it means it's acceptable to me. Okay, so that's a trade. It's a good trade because it's got low volatility, high liquidity, low current IV percentile, and the skew is acceptable. So we go to the Analyze tab. Here's our trade. Now we decide how much are we going to put. I already told you that if we enter 2 lots, which means 2 to sell and 4 to buy, that means 2 straddles to sell and 4 long straddles to buy. That is the trade that I want. So that means right here we have 1. So we create this trade, create duplicate, and then you say confirm and send, and then you say multiple accounts, because that way you can see the current account and the other account. I want to put it into this. If you have several accounts, you might spread out this trade over different accounts. In this case, I just click on the plus, and that's 9,000. Okay, and it's going to apply my option buying power to buy that, and I only go to 9 because I have $97,786 in this trade, and I don't want to go over 10%. And I send that off, and that will be my trade. Okay. Something wrong here. You see that it's down here. It shouldn't be. It should be up here. Okay, let me see. Oh, you see, I'm bidding 528. I see analyze trade. Yeah. If I open this, it shouldn't be like this. Oh, it's because of the adjustment I made to the volatility. It needs to be less reset parameters, and that is more normal. Okay, it needs to be the pink line should cross your dotted line here precisely at the current strike price. Okay, so I'm going to alter this bid so that it gets filled, because I'm bidding for 28 and I'm really the mark is 45.50, 45.28, 45.50. So because this is lower, it's not getting filled. So you can cancel replace, unlock it and lock it again and send it. And we're going to wait until it gets filled. Next we go to our next trade, which is BP. That's British Petroleum, and we see some of the similar things we saw in the other similar things to the trade that we just entered on Palo Alto Networks. The stock is hitting new highs, big jump recently. The earnings beat expectations by a wide margin. Volatility is low. So right off the bat, I can see that this could be a good trade. So let's go to the trade tab, and let's go to this monitor and copy our trade. Okay, so analyze trade. If you don't already have it copied as a template, we need this as a template, and we say create duplicate, and you can see that we have this template. Okay, so click this icon here and call it whatever you will. You can say Genie, or you can say Juan's Trades. Or you can say my favorite. It doesn't matter as long as you identify it. So let's save that. Okay, so now next time when we go to create a new trade, we can just use that template instead of clicking on all those different options that I created my trade with. Go over here and say, okay, I'm gonna go to June on BP, and I'm gonna select the price would be 40. I don't want to trade 39 because as we go forward into the future, they might not necessarily have that 39 option. So we want the 40. And then when we do the rollover, it's always consistent, the same strike price. Okay, now we say we create trade by custom, and here is Juan's trade. Okay, select it, and there you have, that's the trade that I want. So now you see that we're selling March 31st. You can change that to something different. June we know is more than 90 days. So let's analyze that. Okay, analyze the trade, and here it is. March 31st. How many days to expiration? You just click here, add simulated trades, and it says March 31st is 35 days. As long as it is around 30, the March 24 would have worked too because it's 28 days. I would say 35 is fine. Okay, then you go through the spreadsheet again. Okay, let's duplicate that. Let's call this PANW, and now create a new one. Let's duplicate this, but this time we're going to call it BP. We put the BP here. This is in case you want to go back to it, you have all the data. Okay, and analyze that. Let's say copy the trade and paste it in my spreadsheet here. And here you have the price of 7. Okay, so if it is 7, we put a 7 here. 7 times 100 is only 1400. So to go to 90, we can do a whole lot more than that. Okay, to go to 9000. Double click on that, and let's say 45. No, that's too many. Let's see. No, what I want is to put the price $7. What I want to reproduce is the number of trades, 10. Okay, that's 7,000, so we need to do a couple more. How about 12? 13. Perfect. Oh, yeah, we can even do 14. Yeah, that's about 10% of my account. Okay, we'll come back to that, but let's move on to the next is the earnings. Go back to the earnings and to the chart, and it tells you that the estimate was 1.647 and the actual is 3.5. Okay, again, 3.5 was the actual, and the estimate 1.647. 1.647, and that's a beat of more than 112%. If that's 10%, I'm happy. 112%, I'm more than happy. Okay, all right. So that's a green trade. It's telling me you have the green light, but we have other things to calculate. Let's go for the volatility skew now, and go to the Analyze tab, and here at the bottom right corner of your screen, that's your volatilities per leg. The top are the long legs, the bottom are the short legs. Okay, so we're going to enter it here. Okay, so the volatilities 30.55, 23.3, 28.98, and 22.07. Okay, you can see it for yourself. Is positive skew, which is not good. We want it to be 0, but in reality, to be realistic, more than 3%, less than 3% is acceptable. Okay, very rarely you have the front month volatility being larger than the back month. Okay, so that's acceptable to me. Let's look at liquidity. Well, for liquidity, you say create duplicate order, and then you have your mid and your natural. And let's go over here. Mid is 7.03, natural is 7.15. Okay, and that's another trade because the skew is less than 3%. That's simple. 1.7, less than 3%. I'm happy with that. Now we have 3. How about the current IV percentile? We go to the trade tab, scroll down, down, down until you see the current IV percentile is 0. That means it's at the bottom. I couldn't get in lower. Okay, at the bottom of the range. That's 4 pluses. We can trade this for sure. Even though the volatility is high in the market right now, as it declines, hey, this is still a good opportunity for those. And if it happens that the market bounces up from here, you have those two trades to cash on. We're going to then now alter all our positions to neutralize them as they've been declining, and we collect money that way. But first, let's send this. Create duplicate order, and you say confirm and send, and then you say multiple accounts. Why multiple accounts? Because that way it shows you the quantity and how the buying power effect. How much are you going to spend on this trade? Okay. And 13, 14, and that 14 is a number I had calculated before for you, and that's less than 10% and is very close to 10% of our account. So I'm going to send that off, and now we can examine our trades. And as we wait for this to adjust or to fill, we can always increase the price here, the bid, cancel, replace, open it, and send it off like that. And adjust that, and let's adjust the BP as well. Cancel, replace, just open it, unlock it, okay? And that will make it at the market price, more or less, at least at the bid. Okay, so we wait until those all work, or either go down or go up, who knows. Let's work on our trades. Let's start with Adobe. Let's go to the Analyze tab, and we can eliminate all this. I don't want to look at that right now. If I need to, we'll adjust. Okay, so you can see I have 5 legs here. Why? Because when the stock was going up, I was raising my long call here. I was going higher and higher. This is the outstanding call. What do I mean by that? Well, we have a short and 2 longs, okay? So that we have one in excess. That one in excess, I call it the outstanding call, and you can raise that up. What do I mean by that? Well, it means I can sell the 350 and buy a higher strike price. That way I don't alter the potential. I can still make money on the way up, but I'm cashing on the profitable options. Let's reset this. Reset the slices so that I can see clearly where am I. I'm here. Okay. Oh, that's great. The stock is doing exactly what I want to do. It's going down after I corrected I was raising my call, and now that the stock has collapsed, I'm benefiting from the downside. Take a look at the chart. Is it going to go down further? Possibly. Yeah, I think it probably will. If it breaks below the Ichimoku cloud, yeah, it sounds pretty negative. But the stochastic is saying, well, we might reverse here. Okay, so I'm not stupid. I have collected my profits. Now it's time for me to, I have accumulated paper profits. It's time to cash in on them. So how many puts do I have? I have 2 long puts, 1 short put. Well, that excess 1 put is the outstanding put, and I can certainly roll it down. What do I mean by that? I can sell the put at 350 and buy one at a lower strike price, let's say 320. And that way I'm not giving up on the possibility that the stock continue on lower, but I'm collecting my profits and neutralizing my deltas. That's how you know you're okay. Okay, so let's say analyze rolling, and then we adjust. First of all, 350 is the only one that I'm selling, is the 350 April 23 put. And what I'm buying is a lower strike price. In this case, let's say 320. Why? Simply because it has the closest thing to the current stock price, 320. We need to show everything. What happened here? My trade has disappeared. Why? I'm saying show all. Yet I know I have a position there. I saw it a minute ago. Okay, well, in any case, let's just set my trade here. By doing that, what I'm really doing is selling a vertical spread. am I not? I'm buying a lower put and selling a higher put. But in reality, what I'm doing is collecting trades, collecting money out of my trade. And I still don't understand what is going on. Let's reset everything. Okay, so we go over here, Adobe, open here. Yeah, the trade is there. Okay, I don't know why it's not showing in my Analyze tab, or in the Trade tab for that matter. It is here. Okay, in any case, it's too bad because I need to show you. Okay, it's not allowing me to select. There it is. No, it's still not showing it. Well, in any case, I'm going to do my roll down, which is to sell one outstanding put at 350 and go at a lower strike price. Okay, and that way I get $17 out of my trade. $1,700 that I can use for other trades. Okay, the PA. Okay, that failed. Those two trades failed. Okay, and the BP didn't fail. You can see here. Let's go to the activity and positions. Working. The BP is still working. The Adobe got filled, and you can see because the Adobe filled. You can see here what you have. Just to verify that we have the long put at 320 and one long put at 350. This 350 is protecting me against excessive loss on the 350 short. See that? 350 put expires March. It's a short, but it's 350, so I have to protect. So what could happen? I could get assigned this, and that means I will get short 100 shares. But because I have long 300 shares, I'm sorry, long 100 shares. Why? Because it's a short put, and the put holder may put it on me, and then now I have 100 shares. But it's okay because I have this one that I can use to cancel. In the meantime, let it there erode the volatility value that option has. Okay, that's VP. I'm sorry, that's Adobe. I don't know why it's still not showing it. Oof. Oh, there it is. Yeah, there's nothing. I was selecting the wrong account, I think. Okay, so in this account you can see clearly that our deltas are 13%, still negative in case the stock continues to go down, but not by much. I took a lot of the effect there. I collected my money. Let's go to AXP. AXP is American Express, and today, February 24th, yeah, they're not expiring here. Let's deselect that. Okay, this expire next week. Okay, so right now I have money in that profit. Okay, so I can certainly roll this over to the next week. Okay, to the next month. So you select both and say analyze rolling. Because we are a week before expiration, you can do this now. You can close the position, you have a little profit, but because there is volatility, Do I think that the stock could decline, the volatility rise? Yeah, the volatility is only beginning to rise. So yeah, I want to stay in it to get benefit from any volatility spikes or a reverse back higher. So I'm going to go close my March 3 options by buying them back, and I'm going to select expiration a month from now, and that will be April 6th. And then I get a lot of cash back, and then my trade takes the shape of a straddle. If you say hide positions and select all, this is my current position plus my proposed trade. That's perfect. The delta is neutral, so I don't care if the stock goes up or down, and I'm collecting, so my trade costs me less, the cost on it is reduced. Great. In fact, you can create a duplicate order, create a duplicate trade, analyze duplicate trade, and change it to April instead of March, April 6. April 6. Okay, the new trade after this is the same as if I go to the calculator. You see that I have, let's clear this up. You see that I have my current trade is 35.2, but I'm going to reduce it by getting a credit of 6 minus 6.26, and that's the new price. I copy that, paste it here, and that's my new trade. Okay, you can see that both trades are identical. This trade plus the correction and just the adjusted trade. Okay, 316. Yeah, it's the exact same trade. So if this red trade gets filled, this would be a new trade. We can get rid of all that. So let's confirm and send. And then we wait until it gets filled. In the meantime, we go forward with BP is the trade that we're expecting, waiting for it to fill. Let's go to COF, show all, and this is just a call. Okay, that's nothing is going to happen with that. Let's take a look at the chart. Yeah, there's nothing to this 6 calls. We can close it. Yeah, it's actually quite valuable, so let's just get out of this. That's just I would say it was a lottery ticket, but it's a little more valuable than that, so I'm getting out of it. Let's move on to STX. Okay, here we are, March 3rd. So we're going to do the same as we just did for American Express. We're going to roll it over. This is our trade. Okay, select the 2 from month option. They're a week to expiration, so you can roll it to the next month. Analyze rolling, because I'm not going to be here until next week. Okay, and you just want to collect your money when you can, and so I'm going to go April 6th. Okay, I'm going to get $3.27 for that. And then this will be bought back, and we're going to have the April 6th new ones. Confirm and send. And it shows you that it's these zeros means they're in the process of collecting or trying to fill that trade. We'll see if it does. If not, I will adjust the price until it does. And let's go to TSM. TSM, nothing to do here because the shorts expire on March the 17th. If you want to see what the trade looks like, you can see that I have the trade right here, April 21st, March 17. This is the long, that's the short. My original trade after corrections is $11.51. If I were to close that, it will be 1370. Okay, and if you deselect this green one here, just show the closing trade, you see you should get a flat line. Okay, do I want to do that? Possibly. But you see the stock is going down and the volatility is on the rise. Yeah, that looks great. But you say, well, let's collect our money. The volatility is high or low. I think it's pretty decent. It's not high. So I'm going to let it be in case the volatility spikes. Okay? All right. Let's go back to the monitor tab. And all I'm going to do after I leave you is increase those or decrease the credits and increase the bids. Okay, so starting here with the BP, what do I need to do? I need to raise the bid. So cancel replace and just increase, let's say, by 5 cents. Somewhere in there until it gets filled. Okay, I don't know if it's going to fill at, oh, it did fill. Okay, sometimes you need to go all the way to the higher price instead of the lower price. Okay, in this case it's the opposite, and here I'm asking too much money, and for the current mark, which is 622, I'm asking for 626. So we need to bring that down. Cancel replace and unlock it, and then go down 5 more or 6 more, something like that. Okay, that's good. Let's do, I would have to go down a lot in order to get this filled if it doesn't get filled. So go down 5 cents at a time. Okay, in this one, same thing. In this case, the current ask is higher than my bid, so it should have, in the real life, it should have filled almost immediately. Cancel replace, and let's go down 5 cents more. Okay, nothing happening. Let's go same thing here. Cancel replace. 1, 2, 3, 4, 5, and so on. Okay. Sooner or later it will get filled. I will keep doing that before the day ends to make sure that I have all my trays filled. Okay? Okay, I'm going to call it a day here. Thank you very much for joining me, and see you next time. Bye-bye.